Welcome to STRAT this week. Will Woodall, Mike Rarey. The week of January 30th. We're at the end of the month, Mike. It's been a crazy start to the year. I think markets have continued to rally. We're going to look at the numbers this week. But we continue to see sort of this January momentum in the market. We'll dig under the surface a little bit. We're going to look at updates to our framework, and we're going to talk about job cuts and a little research we've done there. So let's first start with the equity prices for last week.
Yeah, so starting off looking at returns, last week was another solid week for equity markets. You see large growth, up 3.4% last week. That brings the total year to date up over 8%. When you think about growth stocks and you think about market indices, you can think about the NASDAQ 100 having its best start to a year since 1999. Good news, bad news, right? Some people would look back on that and say, hey, you know, the tech bubble was really coming towards an end in 1999, 2000. Those were great years. Others would say, well, we know what eventually happened. But regardless, equities continuing to rally despite a very mixed bag. That would be putting it nicely right, in terms of earnings, particularly on the tech side, seeing negative revenue growth, negative earnings growth, and not really beating expectations by a normal margin that you would see for the tech sector. So, you know, once again, this is definitely momentum driven. This is short covering. This is expecting the Fed to reduce the pace of rate hikes this week at the FOMC meeting. Is it fundamentals? Our framework would suggest probably not.
Yeah, and explain, I think it's good to explain the idea of short covering and what that actually does in the marketplace, because volume has been low. Yeah. Volume has not been high.
Yeah, so if you're short a stock and you have to cover it, what does that mean? Well, you have to buy it back. And so how do you get evidence of a short covering? Well, what you would look at is look at the performance of the most heavily shorted stocks in the index versus the broad market. Mm-hmm. When the most heavily shorted stocks for a short period of time are outperforming, they're going up, that usually means they're short covering. And that's exactly what's happened here year to date. Something flipped year to date where the shorts decided to start covering for whatever reason. They made a lot of money last year in many instances. And that's how you get a short squeeze.
Yeah. You also get it from hedge funds getting tapped on the shoulder to shut their books down. Right. And because they are losing money, especially this month, if they're a short-only manager. Yeah. Or even if they're running beta neutral, they're having a rough month. Mm-hmm. So
definitely.
Okay, great. That's great. Let's move on to fixed income, because fixed income sold off a bit on really no news in particular.
Yeah, yields at the shorter end of the curve going up just slightly, whereas yields on the back end of the Treasury curve, think 30-year, coming down just slightly. But not a lot of movement. Everybody's sort of getting in position for the Fed meeting and then the non-farm payrolls report. Mm-hmm. Those are the big things that are coming up. But it's not just the Fed this week. You also have the ECB announcing a rate hike decision and the Bank of England. Right. So a lot of central bank talk to digest. Everybody's sort of positioning for that. Aside from that, pretty much a nothing week in terms of fixed income.
Let's turn to the alternatives.
Yep. So much more excitement. No, also really not a lot going on. Commodities down slightly for the week. Just seasonal factors going on under the hood, nothing big.
Yeah, and we've yet to see, I mean, oil is still priced fairly high. Mm-hmm. So the contributing factor of that to inflation prints coming. Yeah. You know, how will that sort of, you know, the Fed needs that to come down, right? Right.
Yeah, so that's very interesting, right? This idea that inflation is starting to come down, so the Fed could potentially stop hiking. We saw the Bank of Canada paused hiking rates. Mm-hmm. But what you see is actually gas prices starting to come up again, right? And if you think about how much gas prices have gone down over the past 6 months, well, that's effectively like a tax cut for the consumer. Right. So does that mean that consumers now have more money and they're going to go out and buy more goods or services, which is going to keep inflation sticky? So, you know, it's it's a very complex situation that the Fed has to weed through right now, because any good news right now in terms of the economy could be bad news in terms of future inflation prints.
Right.
So you wouldn't want to stop hiking too early, right?
Yeah. Doesn't make any sense.
Right.
So let's move on to liquidity. We've seen liquidity actually go below zero here, and that's not a good thing. It's never happened before. So maybe just walk through what the recent print was and what it means.
Down 1.3% year over year in December. So once again, I mean, we've been talking about this for so long. This is the fastest slowdown in liquidity we've ever seen. And, you know, we said previously, money supply growth never goes below zero because money is not destroyed. You know, money always stays in the system. Mm-hmm. It can just move in and out of different aggregates. How do you measure it? And that's likely what happened here. Obviously, money supply is not growing, but were actual dollars destroyed? No, they probably just moved out of the M2 aggregate, which is one of the monetary aggregates. Yeah. This isn't getting a lot of press. Notably, though, Jim Bullard, the Fed president in St. Louis, who is definitely a thought leader in terms of monetary policy, calls himself a monetarist at heart. And he has spoken to the rapid slowdown in the money supply. And he basically views this as evidence that disinflation is coming. He believes if you slow the growth rate of the money supply very sharply, that will lead to lower prices because of less demand in the economy. Mm-hmm. So it is getting addressed. It is something the Fed is watching. This is exactly what they manufactured. The problem is to think that there are no negative consequences of the sharpest slowdown in money supply growth in history. That would not make much sense historically.
Yeah, it remains to be seen. We've never been here before. So
right.
Who knows how it'll play out, but it's definitely something that is an outlier and is contrary to what we're seeing in the equity markets, because the next graph shows that there's a large gap that continues to build between the S&P prices and the actual liquidity.
Yep. Yeah, net liquidity, so a subset of that money supply aggregate we showed previously. That's the green line. It's been leading the S&P 500 since COVID, and you can see it actually ticked down last week. So it gives about a 2-week lead on the S&P 500. Anytime the S&P 500 or other equity indices sort of break away from liquidity, liquidity acts as a force of gravity. Yeah. So that's another way when we come back to the first slide of the shoot and we say this doesn't seem to be driven by fundamentals, this would be exactly what we're referring to, right?
Yeah, and I guess for the viewer's sake, like this is a great illustration of sort of these market. Here we are. We're still on this downward trajectory here. Mm-hmm. There is no turning here, and especially with this liquidity number here, if we mark it here, where it should theoretically come to, you're significantly continuing your downtrend. So It doesn't make a lot of sense right now to see any support for equities in the current data.
Yes. We would feel a lot more confident that we reached a market bottom if we were able to forecast a turn up in liquidity.
Right.
And unfortunately, we cannot. So.
All right. So let's move to inflation. Got a lot of updates to this graph here.
Yeah. So in terms of our inflation forecast, still seeing inflation coming down pretty sharply, but remaining high. So we think this has something in it for everybody, right? If you're the Fed and you're looking for evidence that you can slow the pace of rate hikes, it's here. If you're the Fed and you're looking for evidence that you should not cut rates this year, it's here, right? Mm-hmm. Because you're still going to be running well above your long-term target by the end of the year.
Right.
If you're looking for evidence that we may be coming into an economic slowdown, it's here. You don't get this sharp of a slowdown in inflation without some slowdown in economic growth. So there's definitely something in there for everybody right now, and the market's really struggling to deal with it. In the near term, you say Fed's going to stop hiking so quickly, inflation's going down. That was public enemy number one last year. Maybe I should cover my shorts,
Yeah.
So.
Yeah. And if you can see on this graph, we're actually showing towards the back half of the year inflation picking up again. So that those types of things are what the Fed looks at, especially on the core side, and will keep them from actually lowering rates.
Right.
And we don't see that happening at all. So,
Yeah.
All right. So we did get the GDP print for Q4, and we have a subcomponent graph here. So take us through what we're looking at.
The actual number, so the first estimate of Q4 2022 GDP growth came in at 2.9%, which was about in line with expectations. But if you look at the subcomponents, which are very important, the top three components, the ones that matter and form trend GDP growth, consumer spending, business fixed investment, and residential investment, those were all weaker than we were expecting during Q4. If you add those three subcomponents together, you get 0.2. So you see that red line in Q4 is about 0.2. And if you trace that red line back further, you can clearly see the slowdown, the continued slowdown in trend GDP growth. The other three subcomponents are the ones that add a lot of volatility to the GDP growth number. They don't, in aggregate, add GDP over the long term. They're really just volatility producers. And so you can see they were the big positive contributors.
Right.
And those are government spending, which was the strongest we've seen in quite some time, net exports, and change in private inventories. So, taking out the noise, the trend is still what we've been forecasting, low and falling economic growth.
Right. The trend is not your friend here, at least for the next 2 quarters.
At least, right.
Yeah. So early Q1 estimates?
About 0.7 right now, but it's so early to tell.
Drives a train through it, right?
Yep.
Okay, let's move on to some updates on the employment outlook. So we've got a new chart here.
Yep.
Take us through this.
So what we're looking at here, if you were to take S&P 500 earnings transcripts and you were to track the number of times that job cuts were mentioned, that's your dark blue line. You would typically think, well, that's a good leading indicator of layoffs are coming, but actually that's pretty far down the chain of decisions that businesses make that are consistent with the slowing labor market. It's actually one of the last few that to actually announce job cuts. There aren't many steps after that. Next, what you see are the actual job cuts get recorded. So you talk about them in transcripts, and then they get recorded as official announcements. So that's the light blue line. So you see that's, Challenger Gray and Christmas tracks those. You see that's also ticking up right now. And then the next step after that is they actually show up in initial unemployment claims, which is the red line. So we know companies have been talking about job cuts. Job cuts announcements have happened, but actual increases in weekly jobless claims have not materialized yet. They're still running relatively low, and that's the red line. So that's just sort of where we think we're at in the cycle. It takes a long time. It's very different from COVID. Those all happen immediately. You had every single step a business could take to reduce its employment happen overnight. Right? It's usually a more drawn out process, and we're coming towards the end of the process.
So what are some of the things companies do in advance of actual cuts?
Yeah. One of the first things that happens is they get some type of earnings or margin pressure, right? And then they're going to go and probably start cutting hours. And so we've seen that. So we've seen weekly average hours worked come down, definitely from the peak, from the post-COVID peaks. You're going to see comp freezes or cuts. Definitely saw that in the financials industry. A lot of cuts, reduces in bonus compensation. Then you might let some of your temporary workers sort of roll, their temp contracts expire and let them roll off your payroll. We've seen that. So if you look at 3-month change in temporary workers, those have definitely declined. Then you might go out and reduce job openings because you're not going to hire, right? So we've definitely seen job openings come down. And then along the way there, you're cutting discretionary spending in other ways. We saw business fixed investment have its smallest contribution to GDP growth in Q4 that we've seen since COVID. So that's definitely happening. Then you mentioned the job cuts. Then you formally conduct the layoffs,
cuts.
and then you show up in initial jobless claims, and then eventually the non-farm payrolls report.
Right.
So it's a long process.
And so the interesting takeaways here are you can see how much of two recessions, right? It's definitely a lagging indicator. So you see it sort of ticking up here. You see it, this was an immediate tick up. Where does this necessarily need to get to before we realize we are in recession or it's meaningful?
Yeah.
Because the unemployment rate is still historically low.
Right. So the unemployment rate is at 3.5%. It only has to go up 0.5% to trigger what would be called the SOM rule, which means if the unemployment rate rises 0.5% from its recent low over a 12-month period, you're in a recession. Right. But to be on the way to that, you don't need the full 0.5%. So, you don't need a whole lot because of how tight the labor market is already. So a couple things are going to happen. Either this is going to work out like every other business cycle recession, and the recession is coming soon, or you say this time is totally different, and then you say all the temporary workers that have lost, they've actually become full-time workers, so you should ignore that signal. And you would say these initial jobless claims are never going to increase because anybody who is actually laid off is just going to turn around and find another job because job openings are so plentiful.
Right.
And so you say, all right, well then recession avoided. But then you have to ask yourself, if the Fed just hiked rates this much and they don't see any increase in the unemployment rate, are they going to feel confident, even if inflation comes down here, that they have defeated inflation?
Yeah.
How could they say, if we get inflation to come down to 4 like we're projecting, but the unemployment rate is still at 3.5 and the unemployed persons to job openings ratio is still at historically tight levels, and you're the Fed, you're probably not going to feel comfortable hiking rates.
Hiking rates, yeah.
Because you would need to see some weakness in the labor market. So this is either going to be bad news now or bad news later, is basically as long as this is the Fed's reaction function.
Yeah, and what impact we're seeing a lot of bad earnings, as you mentioned, Q1 already out of the gate. What impact does the deceleration in GDP and probably the continued margin pressure for at least the next 2 quarters have on this number? Yeah.
So we can actually work out that number, estimate that we need about a 20% reduction in earnings in order to soften the labor market to the point where the Fed can feel confident they've defeated inflation. So
2-0.
The Fed would probably take 10% reduction in earnings. But if you look at earnings forecasts and how the earnings data is coming in, we might not be too far from that. We'll see. But yeah, there actually is a number that you can work out.
We'll try to work that out for one of our future shoots here. All right, speaking of recession, we had a slight lessening of our recession indicator.
Yep.
Explain why.
So one of the big inputs into the recession indicator are market-based inputs. And so when you have January like we've had thus far with equity markets rallying and volatility falling and high yield bond spreads tightening, all those things typically are inconsistent with a recession. And therefore, those are reflected in the model. So you see a little tick down in recession probability, which is nice. This is obviously a noisy indicator.
Right.
So the trend, in our view, is still elevated and up. But that's what happens when you have a strong month like we've had in markets.
Absolutely. What do we have coming up this week in markets?
Yeah, so the major central bank decisions, those will be big, and then non-farm payrolls is coming up. So those will be huge. Mm-hmm. So we've seen this time and time again when we have big economic data releases, weeks like this with central bank meetings. There's a lot of volatility and positioning ahead of these events, and sometimes it makes no sense. And nothing really starts to make sense until a week or two after those meetings and everything's settled. So, would not be surprised if that's what's been going on.
Yeah. Should be an interesting February as we get deeper into the quarter and we see more earnings information and we see more Fed speak. We should have a clearer picture on how this will play out over the next 6 months. But the data continues to underwhelm us in terms of wanting to invest in equities right now.
Yep.
That's it for this week. If you have any questions, let us know, as always, and thanks for joining.